This is Marco with Home Loan Approval Center, and I'm here today to talk about the cash to close associated with buying a home. This will help you understand how much cash to close you will need to set aside. When you buy a home, there's an amount that you will be required to close on your new home. These are costs that go above what you are paying for your down payment. The cash to close is your out-of-pocket for items like getting your home loan, having the house appraised, getting the title transferred into your name, and so on. This means if you're buying a $500,000 home with 5% down, your down payment will be $25,000, and closing costs could range from $8,000 to $12,000 or more. Your total cash to close would then be between $33,000 and $37,000. The amount a home buyer has to bring in for cash to close can vary a lot depending on the home price, location, and other factors. Any earnest money you paid when you made an offer on the house will be credited towards your down payment at closing. Typical closing costs paid by the buyer include underwriting fee. This is the fee from your mortgage lender used to set up and process your application, verify your documents, underwrite, and close your loan. Appraisal fee. This is the fee to have your home appraised. Typically, it's paid at the time you order the appraisal. Title insurance. A title search ensures that your new home's title is clear and no one else can claim rights to the home or property. Title insurance provides protection against undiscovered claims. Escrow fees. These are fees charged by the escrow company. Homeowners insurance. You'll need to prepay a full year of homeowners insurance. Property taxes. A prorated amount of property taxes depending on your close date. Escrow impounds. Escrow is set up so that you prepay money that will be placed in an escrow account and dispersed as necessary to pay for your property taxes and your homeowners insurance. Typically, it's 3 to 6 months of property taxes and 3 months of homeowners insurance. Upfront mortgage insurance or funding fee. Some home loans require an upfront fee to insure or guarantee the mortgage. Government-backed home loans like FHA, VA, and USDA mortgages all have an upfront fee, though you can roll this fee into your loan amount instead of paying it at closing. Discount points. Discount points let you buy a lower interest rate by paying an extra fee at closing. The type of mortgage you choose can also have a big effect on your closing costs, and the biggest of these is mortgage insurance. Mortgage insurance, or MI, is typically paid when you put less than 20% down to buy the home. The mortgage insurance helps protect the lender. Most mortgage insurance is paid with your monthly payment and considered an annual payment. However, there are some loan programs that will also have an initial mortgage insurance premium that is called an upfront mortgage insurance premium, and you may be due at closing as well. Let's look at some of these types of programs with the upfront mortgage insurance. The first program is FHA home loans, which require annual mortgage insurance and an upfront insurance fee. The upfront mortgage insurance premium, or UFMIP, is equal to 1.75% of the loan amount, or $1,750 for every $100,000 borrowed. Despite its name, FHA upfront mortgage insurance doesn't have to be paid at closing. Most borrowers roll this cost into their loan amount rather than pay it with cash. Rolling upfront mortgage insurance into the loan will greatly reduce your closing costs, but it does mean you'll pay interest on the fee over the life of the loan. The next is the VA loan funding fee. VA loans do not require annual mortgage insurance, but they do require a one-time funding fee due at closing. For first-time home buyers, the VA funding fee is usually equal to 2.3% of the loan amount. Buyers who have used a VA loan before will pay 3.6% of the loan amount. If you make a down payment of 5% or more, the VA funding fee is reduced. VA home buyers also have the option to roll this fee into their loan amount instead of paying it along with their closing costs. USDA guarantee fee. Like the FHA loan, the USDA home loan program requires both an upfront mortgage insurance fee and the annual one. USDA's upfront fee is equal to 1% of the loan amount and can be added to the mortgage balance to reduce closing costs. It is important to be aware of all these costs associated with buying a home so that you have enough money to pay your closing costs. If you're not sure, check with your lender. They will cover your closing costs and your options. There are several costs to be aware of when buying a home, but the great news is that your team is here to help you throughout the process. Thanks for watching. This is Marco with Home Loan Approval Center. Don't forget to hit the subscribe button.